Introduction to Financial Statements. Learning Objective. Explain the nature and general purposes of financial statements. Financial statements are presentations of information in financial terms about an enterprise that are believed to be fair and accurate. They describe certain attributes of the enterprise that are important for decision makers, particularly investors or owners and creditors. In Session 1, we learned that investors and creditors are particularly interested in cash flows that they expect to receive in the future. Creditors, for example, are interested in the ability of an enterprise to which they have made loans or sold merchandise on credit to meet its payment obligations, which may include payment of interest. Similarly, investors are interested in the market value of their stock holdings, as well as dividends that the enterprise will pay to them while they own the stock. A financial statement is simply a declaration of what is believed to be true about an enterprise, communicated in terms of a monetary unit such as the dollar. When accountants prepare financial statements, they are describing in financial terms certain attributes of the enterprise that they believe fairly represent its financial activities. There are three types of accounting information: statement of financial position, often referred to as the balance sheet; income statement; statement of cash flows. While examining the financial statements in this session, we will be assuming the corporate form of business ownership. The names of the three primary financial statements describe the information you find in each. The statement of financial position or balance sheet is a financial statement that describes where the enterprise stands at a specific date. It is sometimes described as a snapshot of the business in financial or dollar terms, that is, what the enterprise looks like at a specific date. As businesses operate, they engage in transactions that create revenues and incur expenses that are necessary to earn those revenues. An income statement is an activity statement that shows the revenues and expenses for a designated period. Revenues already have resulted in positive cash flows or are expected to do so soon because of transactions with customers. For example, a company might sell a product for $100. This revenue transaction results in an immediate positive cash flow into the enterprise if the customer pays cash at the time of the transaction. Unexpected future cash flow results if it is a credit transaction in which payment is to be received later. Expenses have the opposite effect in that they result in an immediate cash flow out of the enterprise, if a cash transaction, or an expected future flow of cash out of the enterprise, if a credit transaction. For example, if a company incurs a certain expense of $75 and pays it at that time, an immediate cash outflow takes place. If payment is delayed until some future date, the transaction represents an expected future cash outflow. Revenues result in positive cash flows, either past, present, or future, while expenses result in negative cash flows, either past, present, or future. Positive and negative indicate the directional impact on cash. The term net income or net loss is simply the difference between all an enterprise's revenues and expenses for a designated period. The statement of cash flows is particularly important in understanding an enterprise for purposes of investment and credit decisions. As its name implies, the statement of cash flows shows the ways cash changed during a designated period. The cash received from revenues and other transactions, as well as the cash paid for certain expenses and other acquisitions during the period. While the primary focus of investors and creditors is on cash flows to themselves rather than to the enterprise, information about cash activity of the enterprise is an important signal to investors and creditors about the prospects of future cash flows to them. A logical starting point for understanding financial statements is the statement of financial position, also called the balance sheet. The purpose of this financial statement is to demonstrate where the company stands in financial terms at a specific point in time. The other financial statements relate to the statement of financial position and show how important aspects of a company's financial position change over time. Beginning with the statement of financial position also allows us to understand certain basic accounting principles and terminologies that are important for understanding all financial statements. Every business prepares a balance sheet at the end of the year, and many companies prepare one at the end of each month, week, or even day. It consists of a listing of the assets, the liabilities, and the owner's equity of the business. The date is important, as the financial position of a business may change quickly. Exhibit 2.1 shows the financial position of Vagabond Travel Agency at December 31, 2018. Our total assets are equal to $300,000. This includes cash of $22,500, notes receivable of $10,000, supplies of $2,000, and the balances in the remaining asset accounts. Liabilities include notes payable of $41,000, accounts payable of $36,000, and salaries payable of $3,000. The accounts in the owner's equity section of the balance sheet are capital stock of $150,000 and retained earnings of $70,000. Notice that the total assets are equal to the total liabilities plus owner's equity. Let us briefly describe several features of the statement of financial position using Exhibit 2.1 as an example. First, the heading communicates three things. First, the name of the business. Second, the name of the financial statement. And third, the date. The body of the balance sheet consists of three distinct sections: assets, liabilities, and owner's equity. Notice that cash is listed first among the assets, followed by notes receivable, accounts receivable, supplies, and any other assets that will soon be converted into cash or used up in business operations. Following these assets are the more permanent assets, such as equipment, buildings, and land. Moving to the right side of the balance sheet, liabilities are shown before owner's equity. Each major type of liability, such as notes payable, accounts payable, and salaries payable, is listed separately, followed by a figure for total liabilities. Owner's equity is separated into two parts: capital stock and retained earnings. Capital stock represents the amount that owners originally paid into the company to become owners. It consists of individual shares, and each owner has a set number of shares. Notice in this illustration that capital stock totals $150,000. This means that the assigned value of the shares held by owners multiplied by the number of shares equals $150,000. For example, assuming an assigned value of $10 per share, there would be 15,000 shares. $10 times 15,000 equals $150,000. Alternatively, the assigned value might be $5 per share, in which case there would be 30,000 shares. $5 times 30,000 equals $150,000. The retained earnings component of owner's equity is the accumulated earnings of previous years that remain within the enterprise. Retained earnings is considered part of the equity of the owners and serves to enhance their investment in the business. Finally, notice that the amount of total assets, $300,000, is equal to the total amount of liabilities and owner's equity, also $300,000. This relationship always exists. In fact, the equality of these totals is why this financial statement is frequently called a balance sheet.